Hi, Daniel. Thank you so much for coming to the Investor Talk. How's it going?
Oh, I appreciate it. I'm excited to be here.
This is our second podcast. We've done the first one on the Mentor Talk, so I'm very glad to have you back. Today, we talk differently, right? We talk more about how investing in startups. If you want to give a short introduction to yourself in terms of on the investment side where you're standing, and after we can start.
Yeah, absolutely. So I have a background investing in real estate. So I've invested in built properties. I've had my challenges and setbacks. I started by getting ripped off for about 400,000 pounds. So I've had a couple learning experiences on the real estate side. Then as an entrepreneur, I've both started multiple companies. I've raised investment capital into companies. I've invested into other companies. So I've had a little bit of experience, and then of course we have a lot of amazing speakers that speak at the Swedish Wealth Institute events that teach even more about how to buy and sell companies, and that's been really useful for me now. And when we're creating our roadmap for the Swedish Wealth Institute and looking at should we raise capital, when should we raise capital, how do we plan out, the Series A, B, C, and make that multi-year roadmap. That has been really, really fun.
Thank you. Can you give me a bit of, an intro to how actually approach investing and if you invest in any startup?
Yeah. So to me, I have multiple different, well, we call them buckets for our investments. So the core is in a very stable portfolio, which is a combination of different types of ETFs that one of our speakers, Andy Gupta, who spent 20 years on Wall Street, helped me design my personal portfolio. He's also one of our top speakers at a lot of our events and has taught thousands of our students how to do this. So I have a combination of ETFs that cover stocks in different parts of the world, bonds, gold, even cryptocurrencies now through ETFs to get a part of that upside. So that has been the core base, and that just gives me a good, very predictable return over time. And then from that, that's where you can then siphon off and have smaller buckets, which are more, let's say more on offense, that are more about build, hit or miss, and it's okay. And that's kind of how I've been looking at when I've considered startups, is very much who is it that's running the company? Who is the founder? I think that's really, really important, both because a company is in many ways the extension of a founder, and it will be their values, their ethics that kind of permeate through the organization. But then also the other side is what would happen to the company if something happened to this founder. And that's something I've been working on with the Swedish Wealth Institute, is we are building systems. So even if I disappeared, if anything happened to me, the company would be able to run without me. And at this point, it would still run. It wouldn't run as well. So the next step for us is to make sure that everything is so set up that even without me, someone else could slot into my role and the company would run just as well or even better.
You say something right. When investing in startups, the founders are everything. And for the first 24, 36 months, they are absolutely everything. So there is a massive risk because you're not investing in a company, but you're investing in an idea run by 2 or 3 people.
Yeah.
So, and at the same time, you invest in a stock market, a listed company, a security, which is a totally different story in terms of risk. But you balance the risk and reward. Startups are very much rewarding when you go right.
Yeah.
When you go wrong, when you go wrong, there is no parachute. There is no stop loss. You just lose everything, and that's all. How do you? How do you see the main difference approaching investing in stock market, where of course you need to follow some fundamentals, investing in startups where fundamentals are totally different? Totally.
That's a great question. And honestly, when it comes to the stock market, I completely ignore going into the fundamentals of individual companies. That's why I use ETFs, like indexes of the entire market, because that way it's kind of like Warren Buffett said, if you don't have time to sit and read company reports all day, you should just invest in the index, because it's hard enough to beat the index. I mean, Tony Robbins did a big study in his Money Master the Game, where he found that 96% of fund managers fail to beat the index, which is insane. That's all they do. That's all they've studied their entire life. And 96% of them fail. And the crazy thing is, it's not the same 4% every year that beat it. It's not like some are really good. It's just some this year they beat it, next year they fail. So by investing in the index, you will probably do better than most professional investors. And then you balance that up by having different asset classes, and you do rebalancing, which allows you to take advantage of runs and dips. And there's a whole art to it. But it means I spend about 10 minutes every 3 months now on my portfolio. So that's how I kind of handle the core of my investments. As you say, the fundamentals with a private investment is completely different, because if you say you were investing in, let's take Nvidia as an example, and you were a part of that big rush up, and then they've had their dips, right? That stock has gone up, it's gone down, it's gone sideways. Well, while it's dipping, if you want to get out, you can sell during the dip. It might not be the best time to sell, but you can, and you can get what money is available you can get back. In a private company, it's either it gets to a point where it's going to be sold or going to be publicly listed and you can exit, or it's privately held. So there is no way to sell the shares. So it's either you win or you lose everything. And again, it comes down to, why are you investing in this private company? Is it that, or say, are you investing in 10 different companies? You hope that 2 of them go well and they 100x your investment. Well, in that case, then that's what you're looking for. You're looking for 100x potentials. Or are you investing in 10 companies and your hope is that 8 of them become stable companies that will pay a dividend every year? And that means you're looking for something very, very different. And so I think it's important to know what are you looking for? What is your upside? And be very clear with yourself why you're investing in these startups.
I mean, I don't know if your portfolio includes also startups now, but how would you balance a portfolio where startups, anyway, private investments, whatever it is, SME, startups, they're all pretty much unliquid. And also they're very risky anyway. How do you balance it? Make sure that you get a decent return at least.
Well, for me, right now, I've kind of actually pulled out of most of my small investments because I'm putting everything into my own company. That's my startup investment. But when I've done it in the past, I've kept a 90-10 split. So 90% of my investments have been in my stable portfolio that's going to grow. And because it's going to grow by 10 to 15% a year, it means that even if I lose my entire investment into all these startups, basically means I lost 1 year of progress on my core portfolio. So what it does for me is it gives me a potential upside. It's very fun. It has some excitement, but I don't put myself in a position where a failure would cost me anything meaningful. So I think that is, if you're going to invest in startups, that is really, really important. There is another way to get equity in startups. I've used that a lot more, and that's by coming on as a consultant to startups or as a partner. And instead of getting paid, you take equity. So that's a way a lot of startups as well, instead of having to go out and raise money, they might go, you have these skills, you have this knowledge, you have this distribution. Instead of me paying you $10,000 for your services, let's give you 1% of the company and we'll value the company at 1 million. And if you help us grow, then, that 1%, if we turn out to be Facebook, that could be amazing. and
Yeah.
and it gives you an upside. And sometimes that's better. Just trade time for equity if you have enough time to trade, that is.
That's absolutely true. I mean, founders at the very beginning doesn't have money. They do not have money to spend in paying advisory, pay even mentorship. So giving some equity probably sometimes is the best way to go. How do you? I mean, we spoke about balancing the portfolio. Now, let's say today you decide to go back to investing in startups.
Yep.
Do you feel do you need to meet founders in person, for example? Now it's all digital. I mean, many founders they raise money through LinkedIn, literally through emails,
Yeah.
but you don't see them, you don't meet them. For example, when I do my angel investment, I need to sit down with them when I need to decide because I need to feel the chemistry. I need to saw this guy in front of me, understand exactly who they are, and not just with a CV or whatever it's going to be. But how do you approach it? Do you feel confident, for example, comfortable to invest? I don't know. I'm investing 10K, 20K, 30K, whatever it's going to be, without even meeting these guys in person. Only following probably the lead investor.
Yeah, so I would never invest from an email, right? I mean, there are so many scammers out there that I would need, I need to have contact with the solicitors, with the accountants. Like I need to know that when I transfer this money that the shares will be transferred to me because it's so easy to get ripped off.
Oh yeah.
And I mean, there are so many ways these people do it. They could actually issue you shares, but they'll issue you the shares in the wrong company, or they will have a rights where like they've set up two companies and one company owns the other company and you own in one of them, but the rights to the IP is held in the other one. And like there are all these complicated tricks that people use. So first and foremost, I'm going to be looking at like what are they doing, how is the structure, and if I sense any of that, that tells me a lot of their values, and I would pull out right away. If it's a very straight, clear, this is what we are, this is what we're doing, here is where the money goes, that is the first thing I need to know. After that, if it's a smaller investment, we're talking 10, 20K, I mean, I could do that over a Zoom call. Like I would always talk to the person like this, but I could definitely do it over a Zoom call. I would, if I'm looking at 100K plus, then I'm definitely sitting down with the person. In some ways, you kind of got to look at it as what is the ROI on taking that trip, right? So if I'm going to fly into Spain or the US, that trip itself might cost me anywhere from 2 to 5K. So if it's going to cost me 5K to confirm a 10K investment,
That makes sense.
yeah, that's just not going to work. So either I'm just going to say no, or I'm going to have to trust Zoom. But what I really look for when evaluating a company, because for me, I use a very small part of my portfolio to high risk plays. And I do it in many ways because I enjoy it. Like I enjoy having that, if this plays out, look at the upside. So I more choose to invest in companies that have a huge upside rather than, you could invest in a local gym chain. You could invest in a restaurant. You could invest in, your mom and pop stores, right? And they can be really good investment. If you invest in a good restaurant, they can do really, really well, but they're not going to 100x your return. But they might give you an annual return. I mean, you might make 30, 40% a year of recurring income. So it depends on what you're after. In my case, I would look at, all right, does this company have the potential to 10x or more my investment? And how long will that take? And then what are the odds that I think they can achieve it? And that goes to the quality of the business plan, the quality of the market. What are the competitors like? What is, and now we have to question ourselves with AI all the time. So it's one of those, if someone comes out and says, hey, we have this new proprietary technology and it's amazing, you kind of got to ask yourself, well, how long will it take before AI can create duplicates of that like this, right? It's like when the 3D printer came. And it was like, well, if you were selling power tools and now you can 3D print them, well, is that a game changer? It turns out it's harder to 3D print than we thought, which means power tools don't get switched, but other things do. So you got to kind of look at what's going on in the market. Will this become obsolete, this niche that they're creating? And if it checks these boxes, that's when I go into the founder. So it's more, I would go, your idea is great. Your opportunity is solid. The market is there for you. If you pull this off, this is going to be amazing. I'm going to 10x, 100x, 1000x my investment. Now the question is, can you pull it off? And that's where I need to go into the founder. And a big part is ego.
I mean, it's so difficult now to understand if this technology will get outdated, property will, in weeks or months. ChatGPT, when it was out of the market, was unbelievable. Now, I don't know if third, fourth, I don't use ChatGPT, for example. If I need, I use Gemini. So it's so easy now to be replaced. So easy. And there is no loyalty from the customers at all anymore. Doesn't exist anymore, loyalty from the customers, at least for what I can see. So as an investor, actually, how do you understand when if a technology comes to you? First of all, the due diligence today is so difficult. Founders code with AI.
Yeah.
So there is no proprietary IP anymore because the IP belongs to AI. So which means what I'm doing, you can easily do the same in a fraction of nothing. So today is so difficult. At that point, Daniel, that I was thinking myself, should I go back to industrial? Seriously, absolutely. This is what I'm really thinking. I'm an M&A boutique in London, right? We do M&A private equity. We buy and sell on behalf of clients. And I said to me, actually, I should stop. I mean, not I should stop, but as you said, I've been much more risk taker. So taking a lot in startups and moving almost nothing to private equity and stock. And now I'm reversing everything because AI. Because it's so difficult to protect the IP and the technology, and because ideas themselves are nothing, and because it's absolutely so difficult to understand. And this is, I'm coming back to you. How do I protect this first mover? Where is the first mover anymore?
Yeah, and this is where, and that's such a great insight, is you got to look at what is truly the IP of this company and how hard is it to replace, both for a competitor to duplicate, but also what is the changing cost for a client that's using the service. And there is a part of we still use ChatGPT in the company, and there is a part of that where there is changing cost to it, because I've trained my team in how to use it. You could switch over, but there is a memory of who I am in AI, which is very useful. And I've built up a rapport with ChatGPT. But I could actually ask ChatGPT to write a full summary of its memory of me, and then I can dump that into Claude or Gemini or another AI and switch over. So that change isn't either that big. We also do have our custom GPTs that we've built. So there would be a little bit of effort to build new GPTs through other AIs, but again, we could do it. So there is a changing cost, but the changing cost between AIs is getting smaller and smaller and easier and easier. And that's where you say the loyalty goes down when the changing cost goes down. Yep. So if I use Swedish Wealth Institute as an example now, we're becoming more and more of a technology company, but I don't have any programmers employed in my business. And I think this is how more and more startups are moving into, is we have a whole bunch of technologies that we use, but we didn't build them, right? We'll use a CRM system like Go High Level. We'll use a connection service like Zapier. We'll use, for our community, we use Circle as the core code. And then we bring in, through Zapier and APIs, we bring in other functionalities that together allow us to build something that is unique. Now, is it hard for someone to duplicate? No, because we just bought all these services. Someone else could buy the same. So you got to ask, what is your moat? Like, what is it that makes that no one else can copy what it is you're doing? And I think in that, there are certain things that still hold value. And one of them is those changing costs. Another is community. Another is brands. And others are exclusive content, exclusive relationships. So there are ways to create something that is unique, that is protectable, and that is then hard for someone to switch, because what they have here doesn't actually exist anywhere else, because the same community isn't here, the same people isn't here, the same values aren't here. So it becomes a lot more people driven. That if you think about all these things I'm listing, all of that is the human side. All the technology and AI is replaceable, and I'm buying external services, but it's the humans that I have that make us unique. And then we have a process and a system that allows us to scale very, very quickly and bring in a lot of new clients, which is huge for an investor, of course, because it puts us at a high ROI, and it's very hard for people to replace because it's based on contracts and relationships rather than technology.
I mean, I agree. I mean, the more we go ahead with tech, the more I value interactive contact with people.
Yeah,
absolutely. And I do believe, as the push on tech is so strong, we as a human, we move back to the relationship to one-to-one.
This conversation right here, right?
This is going to happen. It's already happening. I never seen so many people in events. You organize events, so you can tell me more. I never seen so many people in events wherever I go.
Yeah,
people are. I mean, they can't wait to go. They meet people, because we live in an absolutely era of full technology where, yes, you are on the social media, but I don't know. I mean, you're on the social media, but you don't even know now.
Half of the things you see is AI, and you don't even know what is what now.
Exactly. You don't know. I mean, it can be a chatbot, can be everything. I mean, you're talking to yourself probably.
Yeah.
So you're talking to someone.
You'll see a cat video, and it's like half the cats in that video is created by AI, and half of them are real, and you don't know which is which. It's crazy.
It's absolutely incredible. But let me go back to investing. Today it's more related to startups, as we do this for founders. In your past, when investing in startups, do you like to meet those founders on a quarterly basis, getting your monthly report? How do you follow that?
Yeah. So the first thing is, of course, again, that's that final question. Once I've reviewed the business opportunity, is to ask, because that if I look at it and go, yes, the right person can pull this off and it can be huge. Now the question is this founder, is this the right person? And very often it's not. I mean, because there is a big difference also between being a founder and building something huge. If I'm looking for 10 to 100x, this founder that right now might have a team of 5 is going to have to scale to a team of 50 or 100. It's a very different type of manager that takes. And a part of me then will have to ask, is this someone that can grow with this? Or is this someone whose ego is going to keep them controlling every single thing, and the company won't be able to expand beyond them? They can still be great. Like, they could take a 1 million company and build it to $25 million a year of revenue, and they're controlling everything. But they're not going to hit 250 million. They're not going to hit 100 million. And that's where I got to look at, well, am I happy with that potential? Is that what I'm going for? And then, of course, there's that extra risk. If that person is in a car crash and they controlled every single thing in the company, what's going to happen to the company? There is no fallback system to pick it up. So it increases my risk. So ego is my biggest fear when investing in a startup. The second is, what are the qualifications? What are the skills? What are the history? What are the values of this person? Is this someone I trust will take care of me, will take care of their team, will take care of their clients, and can grow in a way to make it successful? Now the ongoing, that would kind of depend on my investment and what my agreed involvement is. I am happy if it's a smaller investment. If I just get the annual report, I feel that's all I can expect. If I can get access to the monthly reports, that's awesome, but I wouldn't expect it. But if I am working like actively, if I'm also consulting, or if I'm on the board of directors, or then obviously I need to have a lot more insight and view. And of course, the bigger my investment is, again, if we're talking 10K, an annual report is honestly all I think I can expect, because otherwise they're going to have to spend too much time and money reporting to me for a very small investment. But if we're talking a bigger investment, then I can ask and expect more for my money. But that has to be clear up front. I can't change the rules after 6 months and say, hey, I know we agreed quarterly reports, but now I want them monthly. Like, you got to stick to what you've agreed.
I mean, you're right. I mean, monthly report requires time. And you're going to spend a lot of time to report any end of the month. They can be used, especially at the very beginning, for growth. So probably the quarterly report is what is the best. Also, because I believe monthly reports are misleading. Can change too much for month to month.
Probably you move one invoice between months, and all of a sudden February looks like crap, and March is the best month in the company's history. And it's like, well, no, half of that was actually in February, so there were 2 mediocre months. It makes such a huge, depending on what industry, of course.
That's what exactly is. I mean, at least at the very beginning, where you're not structured enough, doing the monthly report does make that much sense. But you say right. I mean, you must understand who is the right guy, who is the guy who can bring the company to a billion, for example, 100 million in valuation. But that's very complicated. I mean, you as an investor, I mean, which kind of reading tools you use to understand something similar?
Well, honestly, I wouldn't expect the founder to take it the whole way up to a billion, because I don't think that kind of growth is possible for 99.99% of founders, right? There are a few, your Mark Zuckerbergs, your Bill Gates that have done that, but most will never do that. So that's, again, where that ego comes in, where it's like, well, will you be able to step aside? And, a lot of great founders, they go from being the CEO to being chairman of the board, and someone else comes in and is the CEO, but they still have an overview of their company and they can make sure the values are followed, but they're not running the day-to-day, because their skill set is to lead, maybe up to even 100 people. But if you're building $1 billion company, you're probably going to have thousands of employees, and that is a different skill set. So ego is a big key for me. And is there a plan? Like, who are the other investors, or what are the plans for investors in different rounds? Because that's where equity, like big VCs, are very valuable to that type of a round, because they want the investment to be profitable. Now, you want them to come in with the right mindset, not just to let's scale this over a 6-month period and then exit out. But if they're coming in and they're willing to bring in these superstar CEOs and right connections, then me as a smaller investor in that can just tailgate off of them and know that, like, most of the details will be taken care of. I don't have to handle that. So it depends on what the plan is there. And again, if I look at the Swedish Wealth Institute as an example, I see, I have a skill set at the moment that holds for a certain level. I will be growing and getting mentored by people that have gone further. So there will be a chance for me to grow with the company. But if the company scales as quickly as we hope, at some point, it's going to outpace my growth. And then the question is, do I have the humility to say that this is now more than I can handle? I need help. And that might be just bringing in a COO who is really, really good and can help me, or bringing in a CEO and then I go to chairman of the board.
I mean, you're right. This is a key point. I mean, as you said, as a founder, probably you don't have the knowledge to manage 100 million company. That's a totally different dynamic. The rules behind running a company 100 million. I mean, I've done pretty few turnaround in my life. When you walk in and you need to turn completely the company around because things are not doing right. Many times the problem was the CEO,
Yeah.
most of the time. Because this guy was an entrepreneur, starting a company from 1 million to 10 million. And as I say to everybody, 10 million is a turning point.
Yeah.
I see so many companies failing as soon as they turn the 10 million because they don't have the structure. So
Yeah.
they run the business in completely loss. They are focused on the first line, and what matters in business is the last line.
Yeah.
The turnaround was actually, I say, I don't even need to cut the employees here. We need to cut the CEO. Because this guy has no knowledge. I mean,
Yeah.
he wants to do everything. He absolutely is doing
Yeah.
the chief of sales, chief operation,
Yeah.
management, he was doing everything. So that's the point. Many times you don't have the knowledge. You need to step on the side and
Yeah.
give the running of the people who actually has the knowledge to bring this company to the next level. And this is what also investors deserve in any way.
Yeah. And I think for me, the reason why I'm not doing a lot of external investments right now is you always got to be looking at the opportunity cost, because there are always more people that want your money. There are always investments to find. So you have to decide
Absolutely.
what are you going to get the best ROI on. And that's where for me I see, well, my best ROI is my own business, at least at the moment. Like we 10x'd the company last year. We expect to 5x again this year. And then, we'll see what we do next year. But that is hard to beat. So that's why for me, I'm kind of going, well, why would I put my money somewhere else when we're having this growth? And I think that's an important part as well, is there are so many people that want to invest so they can call themselves an angel investor, or there's a lot of ego in a lot of these plays. And it's important to kind of go, well, whatever decision you make, you're saying no to everything else. So sometimes you got to take your ego out of it and just go, what is the actual best thing for me, for my investments, for my family, my company long term, and kind of try to take the ego out of it.
I mean, this is very. I've been spending probably 20 years of my life between corporations, investments, trading, all this kind of stuff. And after moving to venture capital since 2014, 2010. So,
Mm.
and as you say, it's so many people any single day, they ask you the money.
Yeah.
And sorry, any single minute.
Yeah.
You are absolutely overwhelmed by any kind of form of interaction where people ask you some kind of investment, whatever it's going to be. As you said, you never know what is the best allocation, right?
Yeah.
So you need to very much understand risk reward in any time you put the money,
Yeah.
and the money I'm giving to you means I'm not giving to others. And
Exactly.
I truly believe, I agree with you because I'm on the same page today. Uh, I had to decide where I should put the next 200,000. And I did, okay, I'm putting inside EquityMatch because in the end of the day, it is what I'm doing now, all right?
Yeah.
Uh, on the other hand, maybe if you can put something outside, you do risk yourself. Although we are entrepreneurs, so if we don't, entrepreneurs, at least for me, are all in, all out. So,
Yeah. Well, it's like Jeff Bezos. He became rich to begin with by putting money into Google.
yeah, yeah,
I mean, he was running Amazon and they were doing great, but he put a whole bunch, I think he put 200 or 250K into Google.
yeah,
And
yeah,
when
yeah.
Google made their IPO, that was where he made, his first big, profit.
You
And I
bet.
think that you have a point, is if you put all your eggs in one basket, there is always that risk. I mean, even with your own company, that something goes wrong, like the world changes. Just
Of
look at what
course.
COVID did for my industry with events. Everything changed. We don't do live events in the same way anymore. It's so much more
Yeah.
virtual now.
It is. Although, as I said before, people they still go there because they really need any kind of form of interaction. Let me cover a different aspect of startups. And so founders pitch any second now. You meet them, they're pitching to you. But I see all the pitch. the same. They absolutely this now they write the pitch with the ChatGPT or Gemini,
Yeah.
but they are absolutely even the writing is totally completely the same.
Yeah.
So if you can give them an advice today, because the structure is the same
Yeah.
and how they explain is totally completely the same on paper, is in person that will really make the difference today.
Yeah, no, I agree. I mean, I think the most important thing is the pack you send has to be very, very clear. It's got to be easy for someone to grab, and then be very clear. All right, let's jump on a call and jump on a meeting. But if you don't have a fully prepared pack, like for example, you should have a front page which basically summarizes. We're looking for X amount. This is what we do. This is what we're using the money for. This is the current valuation. This is the 5-year projection. And then here are the supporting documents that show these are our financials right now. These are our financial projections. This is why AI won't make us, irrelevant in the next 6 months. Like it has to just have that true clarity. And I know from experience that most investors, and they should, but most investors don't actually read that document. They just see this founder, wow, look how professional they are. They put together a really good pack. And just doing that makes you stand out from 99% of all these pitches. So if you have that, you're probably at least going to get a call. And if you're an investor listening, you should read the pack. But from experience, again, people are the way they are. And I think more people are now using AI to analyze the pack. So technically they are reading the pack now. And that kind of takes away a little bit of what you're saying there is it doesn't matter as much anymore how the text is, because basically it's an AI telling an AI so that a human can just get a quick summary. So it disappears a little bit, but you have to have that pack so that when the investor gets the AI summary, it doesn't say, well, all of these reports are missing. For us to evaluate this, we need all this information. Because then, again, as an investor, I would go, why haven't they provided this? That's stupid. This person obviously doesn't know what they're doing, and I would probably not even take the call. So a full pack, and then you get on a call and explain, yes, I am the right person to lead this project.
Let me ask you something that it's for me, I try to make all the founders aware that, okay, you should not get the money for the sake of the money, okay? If I'm raising 100K because I need 100K, I can't take 100K from anybody coming around me offering me 100K. I mean, this regardless KYC, regardless laundry money, this is something different. If you get on board the wrong investors, is the end of your you don't even start with your startup. You finish. It happened to me, so I really know what it means. I know what means having a bad mentor. I know what means having a bad investor inside. So I had my first company, I had to buy back everything, a double price, double.
Right.
So this guy was destroying everything. So I told him, give me the price, make your price to walk away. So he made the price, was insane. But what I told to me is what I'm going to do. I had two choices, or pay this double price, which is I know it's fraudulent, or I need to shut down the company. But if I shut down the company, it costs me 10 times more the price I'm going to pay. So I have a choice, right? So it's something that's very nasty to say. It's very disappointing. And also, although you burn a lot of money you can use for your business. So what's your advice? Should founders, and I believe they should, run their own due diligence on investors?
Well, yeah, obviously. But there is another part of this as well. And I love the story of how Facebook was founded. And I'm blanking on his name now, but the guy who founded Napster, Sean, doesn't matter.
Okay.
Sean Parker. So Sean Parker was at Facebook for a very short period of time, but the impact he had was huge because he'd gone through exactly what you're talking about at Napster. He'd been ousted from his company, he'd lost it, and then the company kind of collapsed and he lost everything. And so coming out of Napster, he was basically living on buddies' couches. And he meets Mark Zuckerberg and they start talking, and they talk about that Mark needs to start raising investor capital because of the potential. But Sean says, well, and obviously this is secondhand, but what Sean essentially says is, I've been there, I've done it, let me help you. I'll connect you to the right investors and we'll make sure that the contracts keep you in control. And what he had inserted into the contract was absolutely brilliant and is a big part of why Facebook has been so successful, or Meta has been so successful. And it was that Mark Zuckerberg owned the voting rights in the company. So that meant that when they went through tough times, like when mobile came out and no one really knew what was desktop or mobile or hybrid, like what was going to happen here, Mark basically could just take control and say, this is what we're going to do. We're going to build for mobile. And now it sounds like a simple decision. The problem was the way the ads, the entire income from Meta is ads, right? And the way the ads were built on desktop was the ads were in the sidebar. But in mobile, there was no sidebar. It was only the wall. So when he said we're going to build for mobile, it basically meant he said we're going to remove our entire revenue stream from these mobile devices. And if that then grows, when that hits like 50%, that means that 50% of their traffic is unmonetizable. That is a crazy decision. And no CEO that has to answer to shareholders could make this decision. But Mark didn't have to answer to shareholders because he had the voting rights. He was the only one who could kick himself off of his role. So he said, you know what? We'll take the hit. And they took hits. But then they figured out, how do we monetize mobile? And once they did that, it exploded their revenue. And of course, the stock price went up higher than ever. So there are ways to protect yourself where you kind of make sure that the investor is siloed off to the side and you have an agreement like, this is what you are. You do not have more rights than that. And you protect yourself. Now, it's not a perfect science, but that is a part of it.
It's not a perfect science, but having right votes with different share makes sense.
Yeah,
I think Mark Zuckerberg, I believe, has 10 rights per each share, 10 votes per each share.
Yeah,
which is after you have 0 right, and maybe you have 1 share, 1 vote. So, which means you pretty much own the company with 20.
Yeah, he basically controls the board of directors, which means it doesn't matter.
I think even Bezos has the same structure. But I mean, makes sense. I believe if you invest in someone, there are a few very strong active investors. When they walk in, they're very active and they can be very tough. So if you want to protect yourself from this guy, they want to change everything, maybe they will kick you out. You better have some good protection on your side. I fully agree with you. Founders, when structuring a startup, they should immediately talk with the lawyer and structure a dual share, even 3. A, B, C.
But that also creates then the flip side for the investor, where if the founder becomes the problem and their ego gets in the way, now we can't get rid of the founder. And so it's that battle between, right? And it comes down, you're completely right. Both have to do the due diligence. Do I trust this investor? Do I trust this founder? How do we find that middle ground where we're all comfortable with this investment?
It does. I mean, you can be 100% right and you cannot be 100% protected. There is nothing you can do. But Zuckerberg in this way,
someone's going to be in risk when you make an agreement like that.
But the one invested in Facebook and Zuckerberg having this protection, he got right.
Yeah, exactly. For them, it was brilliant, right? They made billions. So it worked out.
Look at Elon Musk. He does what he wants, period.
Yeah.
And everyone agrees. So which means it's okay for them, otherwise if something does work for you, you won't agree. So I believe that's totally right. But not everyone is Mark Zuckerberg. Not everyone is Elon Musk or Bezos. That's the point.
Exactly.
So let me close with, as an investor, right? To any startup founders watching today, how startup founders should approach investors, which means where they should go, how they should find investors, and also if you can give to them any advice, any recommendation
Yeah.
as an investor yourself.
I think so. What I've done is before I start talking to investors, I try to find a contact outside of my industry who has done this kind of a fundraise and gone through the similar path and basically say, hey, can you advise me on this? And the reason why I say outside of your industry is because everyone in your industry is probably going to be a possible investor. And I can't go to one of my possible investors and say, hey, can you help me value my company? And they're thinking, oh, great, I'm going to invest. Let's get this valuation low or high or whatever their ambition is. So I think you should try to get advice externally first. And then you got to think about who are the people when you're going to start raising. I wouldn't go out with a shotgun and just try to hit anything, right? I would talk to who are partners that benefit from my growth. Because if you look at, so again, for the Swedish Wealth Institute, the speakers that speak on our platform, if I double my company, they double the revenue from me.
Of course.
So for them to say, well, how about you get an ownership stake in my business, we grow my business, and now you're profiting on both sides. For them, the investment is much safer because they can see that, well, if they give me 100K, 2 events later, if I make the events twice as big, they will have made their 100K back. And they're already now in profit, no matter if I screw up the business or not.
Yeah.
So if you can do those kind of deals with your suppliers or partners, now they have multiple revenue streams benefiting, and that makes the investment that much more attractive.
Daniel, thank you so much for coming to the Investor Talk. It's been absolutely a pleasure for me. Thank you so much.
Thank you.